and the bill went from what it should have been to double that. This is a legally binding contract. It's just one of the largest purchases you're ever going to make in your life.
Welcome to Tailored Wealth, where we provide the general financial knowledge you never learned in school. In my 10 years as a financial advisor, I've noticed that when it comes to financial education, women are always an afterthought. I created this podcast with the hopes that we could create a financial space tailored to women as they navigate choices throughout their lives. And this morning, I have the pleasure of speaking with Tony Galasso. Hi, Tony.
Hello, how are you doing?
Good. How are you?
Fantastic on this Friday.
So I'm going to have you intro yourself, but I'm going to intro you a little bit first because I know you personally. So Tony is a mortgage expert with MoneyLink Mortgage. But more than that, I was thinking about how I would describe you as a mortgage originator. Is that the right way to say it?
Yep, mortgage loan originator, yeah.
Mortgage loan originator. Tony, the way you feel about mortgages is the way that men feel about their favorite sports team. They just, you think about it all the time. Mm-hmm. You're always waiting for somebody to bring it up.
Oh, yeah.
If somebody even brings it up a little bit, you have 15 statistics that you're going to just rattle off.
At least.
You love mortgages.
I do.
So I thought, I want to teach the women out there about mortgages. I got to go to the guy that loves them the most. So thank you for being on today.
Well, I sincerely appreciate you having me on the podcast. I'm very honored to be here today. But yes, it's something that I do truly love. I'm passionate about, and I love talking about it.
So how did you get into the industry? Kind of why mortgages?
That's kind of a funny story. I went the university route, right? So I went to college. I went to Florida State, go Noles, even though they're just abysmal this year. But I went to Florida State. I was doing international business as my major. And to really kind of move forward in that path, I would have had to go to grad school, get some more student loans. And I really didn't want to do that from a financial side of things. And so my father, who has been a mortgage broker since 1993 or 1994, I can't remember. He was like, "Oh, come and work for me. It's going to be great." And I was like, "Oh, okay. You're pretty successful. That seems easy. I can be a mortgage broker. No problem. No problem. So
it's just somebody's largest asset.
It's just one of the largest purchases you're ever going to make in your life. So I got my mortgage license on a Monday. I graduated that Saturday, and then I started the following Monday.
Very nice. Good for you. Okay.
Yeah. So I decided to jump into the family business.
You've always loved mortgages. You were just ready to go.
Not at the beginning.
No.
I quickly learned that being in mortgages and real estate is hard. And so for the first couple of years, honestly, I hated it.
Okay.
I really did. Yeah. But once I kind of found my footing in the way that I wanted to explain mortgages and educate and kind of not come from a space of selling ice to an Eskimo, but to educating people and helping them, what we're doing now, learn a little bit more about mortgages, that's really where it kind of all unfolded for me, and I became much more comfortable and confident in what I do, and my business just exploded from there.
And I think that's something I didn't know, and I think a lot of people don't know about mortgages, is I just assumed you get a mortgage, you plug it in, and everybody gets the same rate at the same time. And what you taught me is there's really an art to mortgages. So it's kind of a two-parter because you said it was hard in the beginning. So
yeah.
What was hard about it? And then kind of what's the art of being a mortgage loan originator?
So it was difficult at the beginning because I didn't know what I was doing, right? I wasn't knowledgeable with it. I think that, confidence is gained through knowledge. Mm-hmm. You've heard me say this before, right? The key to success is to keep educating yourself, right? So I think once I was able to get some kind of knowledge under my belt, some years under my belt, I became much more confident, and it became much easier for me. As far as mortgages themselves, they are completely tailored to the individual. Your credit score, the type of property, how much you're putting down, everything goes into your rate or the product that we're going to recommend for you. We like to think of ourselves as mortgage advisors, not mortgage salespeople, right? And so we want to manage your debt on the mortgage side of things, just like you manage people's finances on the financial advising side of things.
So even though with the same information from the same person, you could have two different mortgage originators, and they could quote you different rates, right?
Yes. There's not a huge barrier to entry to being a mortgage originator. You have to be 18 years of age. You have to have a high school diploma and no financial felonies. And then, once you pass the pre-licensing course, you're in, man. That's it. some people are attracted to the industry for the fast money, the commissions and different things like that. So they may steer somebody, unfortunately, towards a product that maybe pays that originator a little bit more. And so they may give them not so great of a product because they're making so much more money on it. And that's really the wrong way to do things, right? You want to find the great, the perfect product for that person.
That's very fair. Yeah, I didn't know that until I started working with you. And you were going through, and I mean, I'm a financial advisor, and when we were talking, you started saying things and they were very technical, very impressive. And I was like, Tony, I trust you. This isn't my wheelhouse. And you locked in a lower rate for me just based on the day and what was going on. And I don't know all the technical behind it, and everybody else doesn't need to learn the technical.
No.
What you need is to find a Tony or find Tony, right?
Find somebody who is, as I say, a self-described mortgage nerd. I am a self-described mortgage nerd and love, looking at the markets and everything like that. And like you said, I can talk about it for hours.
So going into that,
yeah,
you said you work with your dad. It's family business.
I do.
Can you talk a little bit about what that was like when you first started, how you kind of got into a groove, some challenges? Keep it kind of open-ended because I bet you could talk about that forever.
Yeah, no, we'll be really brief. I mean, some parents are helicopter parents and they, want to manage everything that you're doing, maybe in a family business, they're like, oh no, this is the way you have to do it. He definitely wasn't that way, very much so more like a mama bird, right? Where you think you're ready to fly, maybe you are, but I'm going to kick you out of the nest and see if it happens, right? So that really was, it was kind of trial by fire a little bit. He kind of gave me the guidelines of how to do things, answered any questions that I had, but really didn't give me any really easy deals or didn't give me any deals or anything like that. It was kind of, I had to go out, join the networking groups, talk to the people, shake the hands, learn, and become a good originator.
What advice would you give to someone considering working in a family business?
Family business wise, probably, make sure that if you're going into it, make sure that you have enough autonomy to make your side of the business your own. That's something that I really appreciated that I had because he really is a very good salesperson. I don't want to say he's a smooth talker, but his nickname in college was Smooth. That's not a joke.
There are worse nicknames.
That's not a joke. Yeah, his nickname in college was Smooth.
Right.
So, he is very charismatic, and that's how he leads, with it. And I'm completely different, right? I'm all leading with education. If they give you the autonomy to make it your own and do your own thing, that's really where you're going to be successful, in it.
In my office, I call real estate MVP, most valuable purchase, because everybody thinks about it. Everybody wants to talk about it. HGTV is out there, right? And everybody's doom scrolling either on Instagram or on Zillow. So if you're on Zillow, walk us through from Zillow scrolling to actually getting your house keys. How do mortgages play into that?
Nowadays, the whole real estate market has kind of shifted with that lawsuit that happened with the National Association of Realtors. We won't get into that, but just know that the commission structure and the way that you buy a house nowadays is a little bit different. However, for years, my whole career, my whole 11 years that I've been doing this, everybody thinks, okay, I need to go to the realtor first to find the house. But I try to tell people that if you're going to be needing financing, go to the mortgage person first. Get your financing set up, know how much you can actually afford, because if you're looking at $700,000 houses and your income can only get you a $400,000 house, you're going to be severely disappointed. At least if you go to the mortgage person first, you know exactly where you can be laser focused with that realtor, and that realtor already knows that you're good to go. You've already talked to a financing person, you have your pre-qualification or pre-approval letter, and it makes you a much more attractive buyer to sellers when you have that pre-approval, right? That's the golden ticket.
So the pre-approval, is it also called a pre-qualification letter, or are they different?
They're different.
Okay.
They're
tell me
different.
why.
So a pre-qualification letter is, if we just have a regular conversation and you tell me my income is this, my credit is this, I have this amount of money in my bank account, that's kind of pre-qualified. With our pre-qualifications, we take it a little bit step further and we'll do a soft pull on their credit, just to make sure it's okay. Pre-approval.
Soft pull means that you're not dinging their credit, right?
Right.
Oh, okay.
Yes. Thank you.
Got it.
Yes. So soft pull, you're not going to get a notification from Credit Karma that somebody, pulled your credit or anything like that. Because a lot of people don't know how much their payment is on certain things or what their minimum payment is on their credit cards, right? So we'll do that soft pull just to verify that.
Always ask if somebody's doing a pull on your credit. Make sure it's
Yes.
a soft pull so you don't have a billion hard pulls that are digging your credit over and over and over again.
Right. Yes, exactly. Yeah. And so if somebody wants to take it a step further and be pre-approved, which is really the best way to go about things, because then the underwriting process with me goes a lot faster anyway. Number one, we get a hard pull on the credit, right? So we get credit authorization, pull a hard pull on your credit, which is all 3 credit bureaus instead of just one. And then if we get your income documents, so we'll see, your most recent pay stub, last year's W-2, just make sure we have that. Or if you're self-employed, we'll get your tax returns. And then also just a bank statement or an asset statement that shows us where the money is that you're going to be putting down in the house.
So for somebody that says, well, on Zillow, all I can contact is a realtor, I don't know how to contact a mortgage person, how do they find somebody like you?
There's actually a really good website that many people are on called findamortgagebroker.com. So you can go on that. You can search your zip code or your area, just start calling originators. Also, I would just Google search mortgage broker, in your area. I'm obviously very biased on using a broker versus using a mortgage banker or a direct lender. And
Can you say why?
So I think that, the reason that we're a mortgage broker and not a direct lender, because we have the opportunity to do that. But when you're a direct lender, you just have that company's rates, right? You can't shop to a whole bunch of different companies. I mean, we're signed up with probably over 10 to 12 companies that we can look at their specific rates on a specific day to try and figure out who's got best rates, best product for that particular individual. If you're a direct lender, you just have their rates. If you're a banker, a mortgage banker with, a big bank like a Wells Fargo or Bank of America, you just have their rates. So broker-wise, there's a lot more choice for the borrower, or for me to try and find them the best deal. And then also there are statistics out there that say that if you go with a mortgage broker, you're going to save thousands and thousands of dollars. I think it's over $7,000 on your mortgage costs when you go with a mortgage broker, because we're typically cheaper. We run on tighter margins.
Oh, and you have more options.
And more options, exactly.
Okay, interesting.
Yep.
So sorry, I wanted to clarify that.
Of course.
So when we're talking a pre-approval, you find your mortgage broker, you get your pre-approval. Something else I wanted to kind of plug in that I advise clients, because I feel like a lot of times my Zillow scrollers are my dreamers, right? And a lot of times just getting them that first step, they're getting somewhere, right? Well, all of a sudden we're like, let's start from the very, very, very beginning. And one of the things that I recommend before you have anybody pulling your credit is you can actually get your own credit report once a year from annualcreditreport.com.
That's correct.
And at that point, you can take a look and actually see what your credit looks like and clean it up. I know when I first got out of college, I pulled my credit and I realized that Frontier had sent me like a modem that I don't think I asked for it. And I had to mail it back within like 30 days. I did. And they still dinged my credit when I didn't pay for it. They were like, oh, try it for 30 days. And if it doesn't work, then you don't have to pay us. Well, I mean, I had that Frontier on my credit for like 5 years.
Yeah.
And I had no idea. And the thing is, once you find a house that you like, if you have something like that, if you have a ding on your credit, it's not an easy process to get it off of your credit.
No.
While it's not a sexy part of the process, getting your credit all cleaned up before you do the soft pull can be something you can do before you even meet with anybody to make sure your credit's where it needs to be. Am I on track with that?
Yeah, definitely. I mean, if they want to do that, themselves, they can definitely do that. Annualcreditreport.com is a great resource, for anybody, to pull up their credit report and see what's on there. For us, we do offer light credit help, for people. So if they do have, something on there, or if their score is not really where it's at, the software that we use actually tells us what their potential improvement is and the steps to get there. So we do offer that for some of our clients. If it's something a little bit more aggressive, like maybe a collection from Frontier that's put on there, we do have a really great credit repair resource person that they're actually out of an outfit out of Texas, but they have helped it's actually a client brought it to me 5 years ago, fixed her credit like that. And so I've just been sending people to this same person, and everybody's had a good experience.
We'll have to have one of those on then. I'll have to ask you for their name. Okay.
Yeah.
And then mortgage brokers, you want one that's local, you mentioned, right?
I would recommend that, just because they know the area and they can give you a little bit more information maybe than somebody that's out of state. Unfortunately, the majority of mortgage originators that are licensed in Florida don't live in Florida, which is weird. I found that. Yeah, I found that out the other day. And so, I would recommend trying to find a local, because also if you contact a mortgage broker first, they can give you a referral out to a local realtor that they know is very good, or a local financial advisor if they're moving into the area, or, just they can set you up for success if you reach out to them first.
Okay, so you get the pre-approval, and within that, it kind of shows you what your max is that you can afford, or how does that work?
So we take a two-pronged approach to that. So we always show people what their price ceiling is, but then we always say, what are you comfortable with, right? Because your price ceiling might be $1 million, but that mortgage payment is going to be $7,000, and you don't want to pay that, right? So if you say 3,500, now we're a completely different, conversation. So we want to make sure that we know that the number that we put on there is the number that they're comfortable with, not the, shoot for the moon number. It's the number that's going to make them feel comfortable, the number that fits within their budget. So that's usually how we kind of navigate that. Everybody's curious on what their price ceiling is, but
yeah, and it can be dangerous because then it's like, that is the ceiling, not 50,000 above that. That's the top of the mountain.
Yes, exactly. Yeah.
Got it.
Yeah.
And when you're talking about houses versus like a condo or a townhome, what advice do you give people that are just like, I'm on Zillow and everything under 500,000 I'm looking at? How does that work?
I'm going to try and be as non-biased as possible for this. I always tell people that the condo process is a little bit more involved, stringent as far as underwriting goes than if you buy a house or a true townhouse, which we call a planned unit development, where you own the land underneath the townhouse. Yeah. And the reason that the condo process is a little bit more stringent nowadays is that terrible thing that happened in Miami a couple years ago, where the condo collapsed in the middle of the night. It was national news. Fannie Mae and Freddie Mac became very, very tough on condos, and very, very tough on condo insurance. And because of that, insurance rate for condo complexes, the master insurance policy, has become exorbitantly expensive. And so what we found over the last year and a half is that condos have been cutting out seriously required pieces of covered perils to cut down on cost. And so we're putting it into underwriting. We get the master insurance policy, we get the covered perils, and they're deficient. And so it completely ends the process, and that person doesn't get that property. So we finance a lot of condos, right? There's alternative financing that we can do if their insurance is not so up to date, or if their amenities are sold to a third party. There's a bunch of different things. That's deep diving into mortgages, But if you can find a house or a townhouse with dirt, the lenders like that a lot more, and you're going to get a much better interest rate as well than if buying a condo.
So when you say with dirt, there are some places that it's almost like a land lease where you don't actually own the land underneath the townhouse that you have purchased.
So there are some townhouses that look like a townhouse, but you don't have any land ownership. Okay. They're actually structured on a condo platform where the association owns all of the land. So it's
so super important question to ask if you fall in love with a condo.
Yeah, one way that you can figure this out is that if you're, I guess, computer savvy enough to look on the county that you're purchasing in, the property appraiser's website, you can look at the legal description, and if it has the word condo or condominium in it, it's a condo.
Oh.
Yeah.
Because condos, you straight up don't own the land ever, pretty much. Okay.
Nope.
You own some really pretty air.
You own the stuff inside the walls, and that's it.
Ah, got it.
Yeah.
But you don't have to maintain the outside of it too sometimes, which is kind of nice.
That's fair. Yep.
Yeah. Which I guess is circling to my next question for you, is for the women watching this podcast, the single women that are watching this, something that I've experienced a lot in my life is I feel like whenever I go to spend money, especially, no offense, but if it's a guy that I'm talking to, I have to be super mindful of, like, do I have all my ducks in a row? So I make sure that I don't get overcharged or get charged for things that I don't need. So when I start to talk to a mortgage broker, what should I be looking for? What questions should I be asking to make sure that I'm getting the same rate that a guy who went and worked with you is getting?
Yeah, no, I mean, I totally empathize with that. I've never experienced that because I am myself a guy. But I know that, like I think we were chit-chatting about this before, my wife had to get something fixed on her car, and she went to a mechanic that was local to us, and he tried to make her get everything, fixed that didn't need to be fixed. And the bill went from what it should have been to double that. And so that's a huge, huge issue, a larger issue within our society. But as far as working
we're fixing it one podcast episode.
We're going to try our darndest. That's right. So, as far as a single lady out there who's looking to buy their first property, I would just go to your friends and family members, the people that you love and know and trust, and try and get some referrals from them to people that maybe they've worked with in the past, right? Because then referral is an extremely important part of doing any service, right? Because that somebody else that like and trust has used that other person, they've had a good experience. And then as far as questions to ask them, so first and foremost, you need to ask if the rate that they're giving you, it carries any points. So a point, the definition of a point is 1% of the loan amount. And so it's extra cost for the rate that you're getting. I really don't believe in points. There are some scenarios that definitely warrant it. And, if we're at the bottom of a rate cycle and somebody really wants to hammer down their rate for the next 30 years, for sure, let's do it. But, a lot of companies will give you a rate, and in the tiny print at the bottom, it'll say, this rate is based on 20% down, which not everybody has, and buying down 0.5 points or 1 point, or, extra cost associated with it that you wouldn't have to pay. And in the current market that we're in, where interest rates will be, fingers crossed, will be falling, based on all the economic stuff that we see, right? That's another podcast topic. Yeah. But, in a falling rate environment, that extra cost, you might not recoup that, in the time that it would take for you to refinance.
And I want to circle back to this as well, because it's a question I get asked all the time. Everybody hears 20% down, 20% down. This is going to be an unfair question, Tony, because I'm sure the answer is it depends. But What is a rule of thumb that people should be saving as a percentage they should put down on a house?
So I'll just tell you the required minimums for certain products, right? So FHA's required minimum down payment is 3.5%. Conventional's required minimum down payment for first-time home buyers is 3%. For current homeowners, it's 5%. USDA, if you're buying in a rural area, you can look up to see if your home is in there. But if you're buying in a rural area, it's 0%. VA is 0%. So there are different minimums out there, but no, the 20% is not required. I've heard that many, many times, and it's definitely not the requirement.
If you put down less than 20%, do you automatically have to pay what's called PMI? Can you define that for everybody and then answer?
Yes. So depending on the program you go with, you'll have to pay some sort of mortgage insurance. So PMI stands for private mortgage insurance, because it's actual private companies like Essent and MGIC and these other mortgage insurance companies that are insuring your mortgage. If you go with a government product like FHA, it's actually an MIP, or mortgage insurance premium, that you pay every year. But it's just coverage for the lender in case of default, right? And that came into effect, after the 2008 meltdown, where that was much more common on many, many loans. But yes, anything under 20%, you do have to have mortgage insurance in some sort and fashion.
I love bouncing mortgage stuff off of you because you know everything. So I'm going to ask, because I've heard that if you put down less than 20% and you're paying PMI, once you get to 20%, it drops off. Is that true?
Technically, yes, but it's actually 22%. So the mortgage company will drop off your mortgage insurance naturally when they think you've reached 22% equity. However, through a refinance or through what's called petitioning for early mortgage insurance removal, you can get it taken off earlier than the period of time that the mortgage company thinks it will take before you reach that 22% equity, which is always way longer than what it actually is.
If I'm a home buyer, do I start that process? Do I reach back out to you? How does that work? Who gets that ball
refinance
rolling?
process? Me, obviously. But petitioning for early mortgage insurance removal, that's you. So usually every company has a different policy with that, but they may ask you to get an appraisal to make sure that the value that you think your property's at is true and correct. And then if they get the appraisal back and we see that the value's there and the difference between the value and your loan is 20% or more, then you're good to go and they'll remove it within a certain period of months. It usually takes a couple months of processing, but yes.
Wealth of information. What does FHA stand for?
Federal Housing Administration.
And what does VA stand for?
Veterans Administration.
Okay.
So, Veterans Administration, only veterans can get those, or surviving spouses of veterans who were unfortunately killed in action. VA is probably the best product I can get out there because It doesn't carry any mortgage insurance, even if you put 0% down.
Interesting. Okay. And so what about for the women watching that are buying a first house in a partnership, married or not married? How does that work?
All right, this is going to be a mixture of like opinion and fact, I guess.
Go for it.
So
This is a podcast, not a textbook.
yeah,
Tell me what
if you're not married yet, you can buy a property with someone, but just I want to impress upon the listeners out there that this is a legally binding contract. You are essentially getting married by house because, if you ever if you guys unfortunately break up or they're, split up, you're both still on that property legally, right? So if you want to get off of that property, you're going to have to try and refinance. You're going to have to try and, sell the house maybe before you want to. You might not get the return on investment that you get. You might act before it's happened where they've had to pay money to sell the house or to break things off. So I've done mortgages for a bunch of people who weren't married. They ended up getting married or they've stayed together and it's been great, but there definitely has been situations where they didn't, and it made life a little bit more difficult.
And what happens in that scenario if one partner's credit score is better than the other one's? How does that work for the rate?
If there's a scenario where, because for the listeners' information, we have to go off of the lowest borrower credit score. So if
Bummer.
Yes, super, yeah, huge bummer, yeah, huge bummer. Because if you got somebody who's 800, 800 plus, and you have somebody else who's 640,
yeah.
We're going off the 640, So in that scenario where there is a wide gap of credit or maybe income, we see if it might be better for just one person to be on the mortgage. And then if they want to, they both can be on the title and the deed and have ownership to the property. Maybe the person with the lower credit score is bringing more of the down payment. Well, it would make sense for them to be on the title and the deed as well, in that scenario.
And what about when you get married? How does that work with the credit scores? And then same question about buying a house.
So same thing, right? It's almost the exact same thing because it like I said, it's a legally binding agreement, right? So
marriage by house. I'm going to use that. That's good. That's really good.
Yeah, I mean, it's it's the
it's
fact
like when people
of the
are like,
matter.
we're not
right?
married, we just have a kid together. It's
Right.
like, oh,
okay,
that seems
yeah,
pretty
totally.
binding.
You've got a kid and you are legally together on a house with,
Yeah.
for the next 30 years.
Got it.
But no, I mean, on the marriage side of things, Florida is an equal rights state, right? So whether they're on the mortgage or not, or on the house or not, they do have rights to the property. But we do it all the time where maybe the husband's on the mortgage or the wife's on the mortgage and the other spouse is not, or both of them are on the title and the deed, but one of them's on the mortgage. So it's essentially the same scenario, right?
Okay.
Yeah.
And then I guess the last life phase I want to talk about that happens, unfortunately, pretty often is when people do separate or they get divorced. What does that process look like? How does that work with couples that you've worked with that are splitting up? Because really it ends up being usually 3 transactions, right?
The first thing that we ask, usually in separate consultations, is who's going to try and keep the house, right? Because that's most of the time what's going to happen is that one person wants to stay in the house, and then we try to see if they are approved to refinance that property out of the other person's name. Usually the other person wants some equity out of it. So we just see if that's possible. And if it's not, then we have to pre-approve both of them to get their own houses after the sale of the property. So unfortunately, most times people afford to buy a house on dual incomes. And so when we look at it, it's not often that one spouse can take over the whole mortgage payment. So it's usually a selling of the house and a separating of ways.
And it's so emotional. It's horrible.
Yeah.
People have an attachment to your house. It's a sentimental situation, but it's also just such a large purchase, large asset.
Mm-hmm.
And on my end of things, it's always 2 parts in that. Number 1, it's trying to be able to afford the house, right?
Right.
And number 2, it's really that a lot of people have so much of their equity of their marriage, of their lives built up in an illiquid vehicle, right?
Right.
So it becomes something to where when they're trying to split up, sometimes even if one person technically could afford it, if they have to, somebody needs to get paid out or whatever the case may be, you're trying to monetize a lot of times people's most valuable asset. And how do you do that? And to circle back too, I wanted to kind of clarify that a lot of times when people are getting divorced, if one person's keeping the house, it is important to remember that refinancing piece of it, because the person, when the divorce happens, the spouse who's not staying in the house a lot of times is like, I don't want to be liable for that debt, right?
Mm-hmm.
So just kind of being mindful of, especially right now, we're in a much higher interest rate environment. That's a challenge a lot of my clients have had, and I'm sure yours as well, is they're like, wait, my joint mortgage is at 2.9. What do you mean? My new mortgage, if I have to get it, it's going to be at 7%.
Right.
And all of a sudden your monthly payment is so much different. And it's not because your house got bigger. It's not because your kitchen got nicer. It's because the rates are so much higher. And I wanted to ask, in terms of when you do separate, at what point, in our one partner has bad credit example, at what point does that kind of drop off and you're back to just having your good credit?
I mean, on the credit side of things, the other thing that people have to, be aware of is their joint credit accounts, because in a perfect world, every divorce would be amicable and everything's fine, but sometimes it's not. And, if you have a credit card that you're on with somebody else, or you have a car payment that you're on with somebody else, and they decide to stop making payments or run it up, it's going to affect your credit too. So, that's something that they need to get, with their financial advisor, with their accountant or their, CPA, and get everything separated, out, so that your credit can heal on its own with just your stuff, right? You're not tied to somebody else and their emotions, which can be very high during the process. And so it can take a little bit, for that to kind of rebound and go through, usually sometime between 3 months and 3 and 12 months. The other thing I just want to put in there real quick is that, sometimes in divorce scenarios, there is child support or alimony that is awarded to a spouse.
I was just going to ask you. Wait, keep going. Okay, keep going. This is great.
And so, I want to impress upon people that if you're going to do that, and if you're going to separate and try and get out of the house or try and qualify for the house, that child support and alimony has to be received on a monthly, very timely basis for 6 months prior to it being able to be used as income. So people really need to set up, maybe a marriage settlement agreement, before everything's finalized, or, begin those payments ahead of time to have that 6 months in order for it to be able to be used. And then on the child support side of things, in order for it to be counted as well, it has to last for more than 3 years.
Oh, okay.
So that's, just a few pieces of, because a lot of times, a lot of the ones that I've worked with recently, one spouse makes all the money and the other spouse does not. And so they're trying to get back out into the workforce and, get that going. But that can take time to, to find a job. And then also, that child support or alimony might be the biggest portion of their income for right now. And so we really need to get that set up ahead of time and get that going so I can use that in my process.
If in that 3 years you have one kid that drops off and the child support recalculates, is it the lowest number that you're going to have for those 3 years?
Depends on the lender.
Okay.
Depends on how they're going to read the separation agreement and the marriage settlement agreement.
So very important. I always stress this with clients. Your settlement agreement becomes like your Bible. That's what you always go back to. That's what everybody asks you for. They look at. So do not sign anything until it's exactly the way you want it, because it's really expensive if you want to change something.
Yeah.
And it's very binding. So just to be mindful of, it goes to a million different people when you're trying to effectively rebuild your life, right?
Mm-hmm.
And when you're trying to do that, that becomes the blueprint for how did everything get finalized. And especially the clients that I have that come in, and they were what I call like the non-CFO spouse, and sometimes the non-working spouse,
right? Where
this is all new to them, right? And they're dependent right now on that alimony and what that's going to look like.
Right.
That 6 month period. I typically, and I want your take on this, I typically will tell people to rent for that first year anyway, just because you've gone through such a massive change. I don't know anybody who's bought a house and gone, that was a really relaxing process. I also don't know.
Hey, now we try to make it as smooth as possible, right?
I know. Exactly. They haven't met you. Exactly. That's the problem. But for real, the mortgage part with you, I have to say, I've worked with Tony several times and refer clients to you all the time. And you really, it's a seamless process. The fact that I can sit back and feel like I don't need to know the ins and outs of everything about mortgage rates just speaks to how wonderful you and your company are. So
I appreciate that.
Thank you for that.
Thank you.
But yeah, so when I'm talking to people, they never say that home purchases are relaxing, and they certainly never say divorces were a walk in the park.
No.
So a lot of times I just kind of encourage people to take a deep breath anyway.
Hmm.
And if they can take a deep breath for a year and, for the first 6 months, do your Zillow doom scrolling or whatever the case may be. And then to your point, kind of rebuild that credit, get that to a healthy place, get those alimony payments to where it's a security thing too, that you're starting to see that amount clear in your bank account every month and taking a look at that. And then just don't make any big decisions until you make sure it's something that you really want.
Right.
Especially right now because rates are so high and property values are really high, just making sure that you're getting into a house that you really want, which I guess circles to my question for you. And this is going to be kind of our most technical question we're going to talk about. I feel like a lot of people I know are just like, oh, I hear that rates are high. You know what I mean? Well, at least they said that at first, and then everybody really felt it, right? Where everything got so expensive.
Right.
And things have been expensive for a while now. And then we kind of had this light at the end of the tunnel of like, one day we're going to go on this like epic slide down where rates are just going to plummet and everything's going to be good again. And we're going to be able to finance the way we used to. And the more that we're going on, it looks like that light just keeps getting not only pushed out, but dimmer. Is that fair to say? There's hope, but it's a little different than what we thought.
Yeah.
So for people that are looking at, and a fancy word that we're talking about right now is refinancing. Can you kind of go over what that is and talk a little bit about interest rates and where we're at?
Now, where rates are over 6%, last year in 2023, they peaked, I believe, on October 23rd at 7.91% on average nationally, right? So
Brutal.
All those people are going to be able to refinance, in the next couple of years. And, the refinance process, it's very easy, call me or call your mortgage, broker that you trust and, just see where rates are right now. Unfortunately, rates have gone up a little bit recently, but for a lot of my clients back in August, when I contacted them, rates had a 5 in front of them, right? And so I said, hey, now's the time. And a lot of them did take advantage of that. And, the average savings was about $380 a month in their monthly payment, which is huge, right? Huge. My goal is to always try and, the other mortgage gurus out there and all the other people that I listen to that are much smarter than me, but I'll often say, okay, when you're refinancing somebody, you want them to recoup their closing costs in 3 years. I'm a little bit more aggressive. I try to maybe focus on 2 years, or less. But a lot of those people did. Unfortunately, I got a lot of people who told me that they wanted to wait until the Fed dropped their rate, which, as we know, is not always correlated, right? The Fed is a short-term interest rate. It's the overnight cost of money, right? And mortgages are long-term interest rates.
And that's why sometimes when the stock market goes up, it doesn't necessarily mean, or the stock market goes up, Fed interest rates come down, you're like, life is good. Why aren't the mortgage rates doing it?
Right.
That's why.
Right. It's not a direct correlation. And, nowadays, you probably know this just as much as I do. The market is very anticipatory now, right? They anticipate, they almost are betting on what the Fed funds rate is going to be. And then the market adjusts on the Fed futures, right? The betting on what it's going to be. And so, I tried to tell everybody at the beginning that, in the beginning of August that, hey, look, the market's already pricing this in. They're probably not going to go down. They may go up, so sometimes they have that inverse relationship. And when it actually happened, rates went up, unfortunately. And so now, they're definitely squarely in the 6% range. I would say for most people, unfortunately, in the high 6% range for conventional loans. So
they missed out big time if they didn't get something with a 5 in front of it.
Right.
Point being, good news. We all don't need to be mortgage experts. We just need to find one and listen to them, right? Pretty much?
Yeah, something, before I got here, actually, I had 3 conversations with clients who all had rates over 6, one right at 7, and we established what I call a strike rate, right? So I said, hey, look, I know that we missed the last time. I don't want you to miss it again. Let's establish a number where it's going to save you X amount of hundreds of dollars per month, where when that hits, I'm going to monitor your mortgage for you, right? That's my whole job, is to monitor your mortgage debt. And so I'm going to monitor it for you, and I'm going to send you a text message randomly on the day that number hits. I'm going to ask you if it's okay to pull your credit. I'm going to send you an authorization to electronically sign that says that it's okay. And we're going to lock that rate in right away so that you know that you're protected and you're saving your money. And so we have that strike rate conversation. We get it set up. And that's what I did with a lot of people that ended up refinancing and saving a bunch of money in August.
As again, to repeat, when you refinance, it's the same house, same pool, same kitchen, same everything. You're literally just paying less interest. And the other thing is with closing costs, you can roll those into your monthly payments. You don't have to shell out a bunch of cash when you do this, right?
Yep. Yeah. So you can, if you want, we look at all the different scenarios. As you know, I'm a numbers guy. So, we look at, okay, what would it be if you paid your closing costs out of pocket? What would it be if you rolled it in? What if you paid some of it and rolled in another part of it, right? We look at the difference between the payments and what your recoup period is on that, right? Your money out of your pocket versus the amount of savings that you're going to get. And so we go in, we do a deep dive on all that stuff and make sure that everybody's comfortable with the numbers we're talking about. And we're doing how, what I usually tell them what I recommend, but I'm ultimately working for them. And if they're comfortable with not rolling it in, great.
So for people watching that are doing monthly budgeting, what I'm hearing is something you can do to literally change your monthly budget is you could refinance your house potentially. And the only thing it might cost you up front is your time because you're rolling it into your monthly payment. You don't need to have thousands of dollars sitting there waiting to get paid toward the closing costs. You can literally roll it in. You might save yourself hundreds of dollars a month. And at that point, all you're really doing, to your point, is some work and sending you some information.
Yeah.
Do I have that right?
I think you have that spot on. Yeah. And, I always tell people whether they're purchasing or refinancing, if you're rolling $10,000 into your loan, or you're putting your purchase price up another $10,000, it's only going to increase your payment every month by about $50.
Okay.
Right?
That's a good rule of thumb.
3 trips to Starbucks.
Yeah.
Or, well, depending on what you get, I guess.
Yeah, depending on what you do. Pumpkin spice lattes are expensive.
Oh, okay. Well, I don't. I'm a Dunkin' guy. I don't know.
I'm a Dunkin' girl.
Oh, well, see.
It's just fall, so everyone says pumpkin spice latte all the time.
Yeah. My wife's a Starbucks gal. I see it on my statement.
It's expensive.
Oh my God, I cry every time I look at it. Yeah.
So well, tell us real quick, what are we missing? Like, is there anything about mortgages? If you could, as a super fan of mortgages, what would you say to somebody or really want them to know of when they're getting a mortgage?
I mean, we already touched on refinancing. We touched on, that's a good thing to kind of accurately look at. I always tell people, when we go through the purchase process, look, I'm not your mortgage broker for 30 days. I'm your mortgage advisor for 30 years, right?
I love that.
I want to manage your debt. I want to manage, your mortgage debt. You have an advisor for your finances. Why not have an advisor for your mortgage, right? So picking the right mortgage broker or the right mortgage person is something that people should definitely look at. And I always tell people to get a second opinion, even if they're talking to me first. A house is not just a place where you eat breakfast every morning and, you fall asleep at every night. It's an investment and you have to look at it that way. And, along with somewhere that you actually want to live at, right? But, houses do historically appreciate, right? I think appreciation is going to be a little bit lower the next couple of years, but regardless, it's still going to be an appreciating asset. So, when you have people that bring the argument of, it's better to rent than buy or anything like that, I think that they're forgetting about the appreciation side of things and compounding interest, right? That appreciation goes up more as the value of your house goes up more, compounding interest, that's something that's extremely important and something that you look at every day and probably talk about every day. So just not losing sight of the fact that this is not just a place that you're going to live, but it's also a place that's going to help your financial future as well.
Yeah, 100%. And I appreciate you saying that. And the other thing too is it's something where you don't have to go out and work to do it. You get to enjoy your house and have your money working for you, which is what I tell clients all the time. Make your money work harder than you are working.
Exactly.
And if all you have to do is sit and enjoy the house that you really like.
Yeah.
That's my other thing I always tell people. If you don't, it's like going to try on clothes. If you don't love a house before you buy it, don't buy it.
No, because then you're going to sell it much sooner than you need to. And you might not see those appreciation gains, over the time, right? Average time that somebody stays in a house is 9 years. Nowadays, it used to be 7. It's increased a little bit after COVID, but 9 years, that's perfect. And you're going to make a ton of equity on that house over that 9 years.
The other thing I wanted to point out that you were saying is When you're looking for financial advisors, make sure that they have somebody in mortgages that they work with, because I feel like I do a much better job advising people because I have a mortgage expert, you, who can collaborate with me to kind of provide that larger picture for them. So a lot of times, hopefully, if you work with a financial advisor, they already have somebody like a Tony that they work with, and vice versa. I know you have a lot of different professionals that you work with. Can you kind of touch on your network and how that works?
So yeah, I think it's, building that. This sounds so cliche. The circle of trust.
Your network is your net worth.
Right. Yeah. Exactly. Yeah. Exactly. Right. So you want to build those people that are tried, true, and tested, that are really going to be a reflection of yourself. And I don't give out referrals lightly. That's why I refer people like you that I know do a good job. That's why I use you. And so I think being able to be, if I am that first domino, that's in there, being able to be very confident in the people that I refer out, that they're going to do a great job for somebody who's maybe new to the area or buying their first property, that is extremely important, to have a realtor, that I know, like, and trust, or realtors, I work with multiple. So realtors that I know, like, and trust. And, the home inspector that, if somebody doesn't have a home inspector, that
Home inspectors are huge.
Right. Yeah, exactly. Yeah, it's extremely important to get a home inspection on your first house. Please do that. And the ancillary people, so the financial advisors and the tax preparers, or the CPAs, the different people that are involved in everybody's normal financial life. It's important to build that suite out for them.
When you said CPA, you can write off your mortgage interest, which also can be a nice tax deduction for you. So there are a lot of different things that you can do with your home, not only just building equity, but that are beneficial to you in a lot of different areas of your life. And that's why you really want to build out a team of people that you work with, a team of financial experts. So I'm very happy that you're on my team. Thank you so much for coming today.
Of course. Very happy to be here. That was fantastic.
Where can they find you? Where can everyone find you?
So if you want to follow me on the socials, you can find me on TikTok. I put off TikTok for a long time, but I'm finally on TikTok. So TikTok and Instagram, you can find me there at Good Guy Mortgage. And then on Facebook, you can find me at Good Guy Mortgages, plural, because somebody apparently had the singular Good Guy Mortgage. But yeah.
Well, you do multiple, so that kind of worked out.
I do a couple every year. Yeah, just a few.
Well, thank you so much, Tony, for coming on today. I appreciate your time. And thank you all for listening. And until next time, remember that wealth suits you better when it's tailored.
Thanks.
Good job.
Rock and roll.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through MFP Financial Services, LLC, a registered investment advisor and separate entity from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Tony Galasso and his company are not affiliated with or endorsed by LPL Financial or MFP Financial Services, LLC.